Let's go.
Hello, everyone, and welcome to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. Some investors, they shy away from using leverage within their investment portfolios. However, for others, it can provide opportunities. Well, I am very excited about our next guest, who is also sporting a quarter zip today. We're trying to start a new trend in the investment management space, quarter zips all the way. But our next guest is an industry expert and is here to share his insights into the world of leverage and leverage ETFs. But first, today's episode is sponsored by the award-winning Zephyr, which helps investment professionals make more informed investment decisions on behalf of their clients. I am honored and excited to welcome Matt Markiewicz. Matt is the head of product and capital markets at Tradr ETFs. Matt, thank you so much for coming on the show. It's such an honor to have you on. I'm really excited about this episode. Now, can you please tell us a little bit more about yourself and Tradr ETFs?
Yeah, thanks for having me on, Ryan. So I'm a 27-year veteran of Wall Street, and I specifically have been in ETFs for the past 16 years, have launched dozens of ETFs as part of larger asset managers and asset managers that I've helped start. Currently, running capital markets and the head of product at Tradr ETFs. Tradr is a brand that was launched in May of 2024 from the investment advisor Axis Investments, spelled AXS Investments. Axis has 1.1 and change billion under management across various ETFs and mutual funds. The Tradr brand represents a brand of ETFs that are more, I don't say catered, but you go after investors who have a shorter investing horizon. Maybe it's daily or intraday or, a year or so. But, we're not going to be launching a Tradr. We're not going to be launching beta products that are, just kind of set it and forget it type of products that some of the larger issuers may be, putting out there. So currently we have 16 ETFs at Tradr. Okay. All are leveraged, as you mentioned. And we're excited to be on the podcast today.
Fantastic, Matt. It's interesting. ETFs, they're growing in size. I read articles, they're eating mutual funds lunch, right? Just taking over the market. And I like watching some of the new ETFs that are out there. And I think it recently closed, but one of my favorite was the inverse Jim Cramer ETF some time ago, where the ETF is doing everything opposite of what Jim Cramer is doing. There's some unique ETFs. Do you think it's kind of getting a little too crazy with some of the very niche, unique ETFs out there?
Well, as someone who has launched, quote unquote, crazy funds in the past, sometimes they work and sometimes they don't. And it depends where we are in the investing cycle, what may, catch fire, right? Depending on what the market view is of stocks, bonds, or whatever asset class you're kind of looking to attain exposure to. There obviously is a sort of a finite end to what can be launched in an ETF wrapper, but I don't think we've reached the peak of insanity or craziness yet, because there's still, I think, a lot of white space, some of which we're hoping to explore at Tradr. And at the end of the day, Ryan, the market will tell you if that idea was successful or not, right? While in theory or on paper, the inverse Cramer ETF might have been popular with retail, investors, that's called self-directed investors. I don't know what the performance was of the fund, but just the market didn't have the uptake that was needed to kind of keep the fund open. And that's kind of part of being in this asset management business, right? It's the barriers to entry of, launching most types of ETFs are fairly low. And that's why you're seeing such a proliferation of, in some people's words, crazy ideas.
Yeah, fantastic. I love it. So leverage ETFs. Tradr is known for leverage ETFs. That's the ETFs that you offer. Let's just start at the top here. What are leverage ETFs?
Well, leverage is a way to get, you could say, amplified or increased exposure to an underlying benchmark or stock or asset class, for instance. And with leverage, think about it as you're using the same amount of capital to get more exposure, or you're using less capital to get the same amount of exposure. So it's a capital efficient tool to
Mm-hmm.
try to deliver returns.
Fantastic. I love that way of explaining it. Some of and the retail side might think of margin, right? Using margin to gain leverage, or increase your exposure to an equity with the same amount of capital or less, like you said. So great way of explaining that. Some people, like I said, might be a little bit worried about using leverage in investments. Some people might think of it as an opportunity, just like you said. Why should one consider using leverage ETFs?
Well, first of all, I mean, leverage isn't a four-letter word like people think it is. It might have a not the best perception in investing or investment management, because of kind of the current structure of the way most of the products are designed. But at the end of the day, if you have a house and you used a mortgage to buy that house, you are leveraged. You're using capital that you have, some amount of capital, and then you're using capital that you don't have to purchase that asset, right? So leverage is actually a very familiar concept to a lot of investors. It just, again, traditionally hasn't been very appropriate, in the equities world or in the investing world because of the way that margin is calculated and the volatility of the underlying asset. Houses really aren't too volatile in nature, right? You don't have daily liquidity in a house, which could potentially make it even scarier. That you are using leverage, and that's why we got into the global financial crisis back in 2007. But leverage, again, as it's been built for the past 20 years, especially in ETF land, has been built kind of the same way. And what we're looking to do is kind of change not only the perception of leverage, but how it's used by financial advisors and investors.
Fantastic. And you brought up mortgages, which is a great example, but how many people own a car, right? And have a car loan out, or leverage, like you said, is used all over the place. And while it might be scary in investments, it could be a useful tool also. So you brought up, the four-letter word. Some think of it as a four-letter word, but what are some other misconceptions about using leverage in investing? I'm sure there's a lot out there of, like you said, some people think of it as a four-letter word.
A lot of it just kind of level set depends on the investor's trading style or investment horizon. So, the current suite of leverage ETFs that exist in the United States, 200 plus ETFs, they all sort of share the same mechanics under the hood, meaning that they reset their leverage daily. So you're getting that amplified exposure to a certain index or asset, but you're only getting that exposure for a day, right? Now, the problem is that might not be suitable, that type of exposure, for an investor who has a longer term investment horizon. So putting a client in a daily reset leverage product doesn't necessarily fit if the client is investing for the longer term,
Mm-hmm.
right? And we can kind of go into kind of why that's the case. So, leverage ETFs have gotten, a bit of a bad rap, and, sometimes rightfully so, but it's how the tool is being used, right? And
Mm-hmm.
how, and by whom and for whom. And again, that whole, I guess, paradigm of using leverage in a longer term portfolio generally has been frowned upon because of the products that are being used. But as you mentioned, margin, individual or self-directed investors use margin all the time, again, to get exposure. Options, right, are a way of using leverage, right? It's just not, they're not called leverage products, but you're using a small amount of capital
Mhm.
to get, amplified returns or looking for amplified, positive alpha. And options do come with their risks, just like leverage ETFs do, right? So it's more of how the tool is being used and in whose hands, really. If that's kind of like that's our view.
I'm really glad you brought that up. And no, there is a huge difference. And I'm sure not many investors right now or financial advisors realize there's a difference between the daily and longer term reset. Can you maybe go into a little bit more detail there between what the different, it's pretty clear daily and longer term reset, but why it's appropriate for some investors and why it's not for others?
Sure. So as I mentioned, there's over 200 leveraged ETFs in the market right now, representing about $100 billion in assets, give or take on the day. And those products, I mean, the let's call them legacy leverage products, have been built to deliver, X times exposure to a certain asset or asset class, but you're only getting that exposure for one day, right? So if you have a two times S&P 500 ETF, you own that. You bought it in the morning at 9:30 Eastern when the market opens, and you held on to it for weeks. And let's say you held on to it for 2 weeks, and the S&P 500 was up 5% over those 2 weeks. We had a nice run. Um, there's a chance that you may or may not get 10% return on your 2x leverage S&P 500 ETF because you're not the product is not designed to give you 2 week exposure. It's designed to give you day-to-day exposure. So it's that daily volatility. You could call it beta drift. You could call it volatility decay that ultimately will impact the point-to-point return of your investment. And again, when the issuers behind leverage ETFs, let's call them traditional leverage ETFs, launched the products, they were, I don't know, I don't want to say they were only limited, but maybe they didn't figure a way to kind of how to make the, longer term leverage possible. But you were only designing the product to give that point to point, which is close of one day to the close of the next day, return on that index or asset class.
That is a perfect way of explaining it. And I could understand. And you talked about maybe those misconceptions and advisor. As an investor, if you see that, you see like that 5 day period, the market's up, 2 3%, and you're not getting 4%, you could kind of question, well, what is this thing, right? When it's a two-time S&P 500 to leverage ETF. So I could see that. So longer term reset, obviously. What's the longest term that you guys offer?
Yeah, so in September of 24, we launched the industry's first what we call calendar reset leverage ETFs. And they reset their leverage on a calendar, let's say, for the answer to your question, we have a calendar quarter reset.
Okay.
So our SPYQ ETF, before fees and expenses, seeks to give you 200% the calendar quarter return of the SPY ETF. So that's the reference asset, right, which tracks the S&P 500 index. So the quarterly reset is currently our longest reset. We also have some monthly and weekly exposures as well.
Fantastic. I love it. So when you invest in these, what leverage ETFs, what type of allocation would you use? How would a financial advisor incorporate it into a portfolio? Now I understand everyone's going to say, well, it depends on the investor, aggressive, moderately aggressive, and what their risk tolerance is. But do you just, is it kind of like a separate sleeve, 2 3 5% of the portfolio, or is it based on, the overall allocation to equities?
Well, we could probably talk for a while about this, but overall, yes. Like I'll just say straight up, it just depends on the risk tolerance of the
Yeah.
the end client, right? So you're not going to put an 80-year-old retired person who's looking for income in a 2x Nasdaq 100
Mhm.
ETF, right? That's not appropriate. Let's just kind of get that out there in the open. But to the extent that the advisor or the fiduciary is running a model and they have exposure to US equities, the tools that we have enable you to get that exposure to US equities, let's say, and get, amplified exposure. So not just one time the return, but you can get two times the return. So what you're doing is that you're getting that return. You're looking to get that return with less capital.
Hmm.
So in other words, you can take some of the capital you're not using to get that exposure and put it into something else. Maybe it's a yield bearing instrument, a fixed income ETF, or a dividend ETF, right? So you're looking or your goal, you say to a client, I'm looking to beat the S&P 500 every year by 2 or 3%, right? So how do you do that? And, using a longer term leverage ETF could be a way to get that efficient exposure to US equities or to the S&P 500, and use some of that excess capital again to help get some yield or some income in there, to help generate that alpha to beat the S&P 500 again, if that's the advisor's goal.
Yeah, fantastic. I think, I talk a lot about this over on these episodes. Really, as a financial advisor, know what you're investing in. Like, and this is a prime example. You go into a leverage ETF, you want that amplified returns that you talk about, but you need to understand whether it's a daily reset, longer term reset. Make sure you understand what the ETF is to better align with your clients' objectives, risk tolerance, and so on.
Yep. And I just, frankly, the nexus for this calendar reset idea, we do operate four daily reset products, three of which are inverse. So they short a specific stock or reference asset.
Mhm.
And we were getting feedback from advisors, actually, some advisors saying, "Oh, I bought your Tesla short ETF 8 months ago. Tesla is down 3% over that time, and your ETF is only up 0.5%. Let's say I'm making these numbers up. I don't understand what's going on here." Well, first of all, you probably shouldn't be investing in a daily leverage ETF for clients over the course of 8 months, unless you really know what you're doing. And also, you're investing in one of the most volatile mega cap stocks out there, being Tesla. So again, that daily volatility is going to drag on the performance, and you probably will not get, over the longer you hold that asset, whatever the return says on the name of the fund. So a lot of this idea of these counter resets, again, was born out of feedback we've gotten from actual investors, right? And we noticed that there was a problem. There was this mismatch in what their expectations were and what the returns were. And that's when we sort of came up with the idea to put this in an ETF form. There are a couple of mutual funds that do have a longer reset, but as I mentioned, we were the first to do it in an ETF structure.
Awesome. So, for example, with their quarterly reset product ETF, is that something where you would, if I hold it really for that quarter, that time period, then, or if you did like a 6 month reset, hold it for that 6 month time period? Is that really the best way to, you know, incorporate these ETFs?
Yeah, well, I think it really depends on how often you're rebalancing a client's portfolio.
Okay.
Right. So very rarely do advisors or intermediaries in particular kind of move things around every month. Right. You have, if you're handling the investment chores for your clients, which some advisors do, some offload that to models or
Hmm.
somebody else, and they just kind of follow a framework that they're not responsible for. Um, you know, we found that a quarterly readjustment or reallocation of kind of your asset allocation is really probably the most popular,
Hmm.
right? So in other words, you have a client in a 70-30 portfolio that you're responsible running the investments for. You don't put it in an asset allocation fund, which they do exist, or target allocation
Yeah.
fund. Um, one that as I said, that you're kind of rejiggering the portfolio every quarter. Then, for instance, our quarterly resets might be more appropriate, right? So that you're getting that leverage exposure over that time span. If you do it more frequently, so you're reallocating every month, which we are seeing kind of, more RIAs who are maybe a little bit more tactical,
Hmm.
uh, kind of refiguring their portfolio. New names come in, new names come out, depending on what's going on in the market. From that perspective, then a monthly reset might be more appropriate. Another way to think about it, Ryan, is the longer resets are a systematic way of selling strength and buying weakness,
Okay.
right? Because let's say the S&P 500 is down 2% for the month. What we're doing at the end of the month is when we relever the holdings and relever the portfolio, we're getting back to that 2x exposure. So we're buying more of the SPY. If the S&P 500 was up 3% during that month, what we're doing is, and your leverage essentially is lower than higher than two, rather, sorry, lower than two,
Mhm.
we're going to be selling it, right? So we'd be capturing those gains.
Yeah.
So I think a lot of that is rare, that whole systematic, buying weakness, selling strength. That message has really resonated with advisors because they don't have to do it themselves,
Yeah.
right? And they know exactly when it's happening. They know it's happening on the last trading day of the month. We're going to be putting that trade
Mhm.
in place to either take chips off the table, or essentially buy more chips with the money that's right in the portfolio to get that exposure, that 2x exposure.
Fantastic. Great examples there, Matt, of how they're created, how they use them, and incorporating them. Good stuff. You mentioned, leverage ETFs. There's roughly $100 billion in AUM across all the leverage ETFs out there, whereas the entire ETF market is what, 4 trillion roughly, and
And
growing
growing.
quickly.
Yeah.
um, why hasn't leverage ETFs kind of taken off with the broader ETF market? 100 billion? Yes, it's a sizable piece, but nothing like the 4 trillion market and growing that the ETF space takes
Yeah.
over.
Yeah. Great question. Well, I think a lot of it comes down to what type of investors are responsible for the growth of ETFs,
Mm-hmm.
and who are leverage ETFs suitable for. So, while retail or self-directed investors have been using ETFs, in greater scale, um, a lot of that growth has come from, the advisor side of the equation, right? The
Mm-hmm.
fiduciary side, institutional side, where, they've been replacing mutual funds, for instance. As you said, mutual funds have been kind of losing market share. I don't know how many years it's been, but a lot at this point to ETFs on, as far as the asset side. And as more advisors and intermediaries use ETFs like that, that's responsible for a lot of that 4 trillion, right? I'd say that the investor base, that self-directed retail base that's using leverage ETFs, they're in the product, but they're not holding it for years or months.
Mm-hmm.
Okay, so you're having a higher turnover, as you should, in these high risk, high volatility products. Now, for instance, the largest 2x S&P 500 daily reset ETF right now, the average holding period is about 21 days.
Okay.
Okay, so you're holding, again, a product that's intended to be held, or at least the regulators want you to kind of hold it for a day. But the average holding period is about 21 trading days, or fittingly enough, a calendar month. Right. So there's a lot of turnover there. Not like putting it in IVV or VOO, for instance, one of the or SPY,
Yeah.
right, where you have a just kind of set it and forget it. So investors are using the leverage ETFs for a shorter term horizon. But again, they're not appropriate for the daily resets anyway, for years on end, right? It's just not suitable for most types of clients. So again, you have
Mm-hmm.
the investor base that's responsible for the growth of ETFs, and they realize that using a daily reset product just isn't really appropriate for most of their clients.
Yep. Fantastic. We talked a lot about these different resets. Can you provide us an example real quickly of a trader ETF that incorporates a longer term reset?
Yeah, so our MQQQ ETF, that's our monthly 2x triple Q ETF. That gives you 200% the monthly return before fees and expenses, of course, of the QQQ ETF. That is, we've had the most traction kind of in the QQQ suite right now. I think, investors are still very bullish on growth stocks.
Mhm.
We're coming, obviously into a uncertain time in the market with the change in administration. I think there are a lot of worries about what's going to happen to interest rates. Obviously, higher rates can keep a lid on small cap growth, but the mega cap tech stocks, right? We're still seeing a really nice bid for the Mag 7 companies with
Yeah.
really strong cash flow that are engineering buybacks. And remember that ETF, the QQQ ETF, it's 100 non-financial stocks, right? That are generally more growth in
Mhm.
orientation. And right now, value did have a quick moment in the sun last year. It didn't last too long, but I still think that there is a tilt towards investing in growth stocks. And M triple Q is a really good way to kind of get that exposure again in a really capital efficient form.
Yeah, fantastic. I agree. Well, I do think the breadth of the market the breadth of leaders is going to expand some. I still think growth in those AI names, stocks that are, connected to AI tech are still going to lead the day, and you're still going to get strong performance throughout all this uncertainty that we're going to get, whether yields continue to climb closer to 5% and stuff like that. So, uh, Matt, we've come to that time for a fun story. I always like to talk about finish it. Anything fun, could be market related, outside of markets, anything interesting going on that you've seen that is newsworthy.
That's newsworthy. Geez.
All right, it couldn't even be newsworthy. It could just be newsworthy for Matt.
Yeah, well, I notice over your left shoulder there, is that a University of
It
Wisconsin
is
basketball?
on Wisconsin, on
Okay.
Wisconsin, Matt.
Well, one of my favorite UW graduates is a former pro hockey goaltender named Mike Richter.
Awesome.
And
Yeah.
he was a childhood idol of mine. I'm a huge New York Rangers fan. I don't
Okay.
know how many hockey fans we got there that'll be watching the podcast, but I had the opportunity a couple years ago from a charity event to attend a New York Rangers game and sit next to Mike Richter, and he was one of the most genuine, kind people, and especially sports stars that I've ever met, and really interesting too. He's kind of in a clean energy venture right now, and he's
Okay.
after he graduated, he stopped playing hockey. He went back to Yale to get a graduate degree, and just a really curious, interesting human. And whenever I see kind of UW paraphernalia, I always think of Mike, as he was he played goalie there and played for the U.S. Olympic team, represented our country. I believe it was the '88 Olympics, and yeah, just so anyway, uh,
I,
not newsworthy, just a little personal anecdote, and go
no,
Badgers.
I love it. I like, yeah. And whenever we can bring up Badgers on the podcast, I'm all for it, Matt. Um, I'm a big hockey fan. I really enjoy it. To me, I think it's the best sport to watch live. Just the excitement. You're on the edge of your seat all the time. It's so fast. But yeah, Mike Richter, there's been a lot of great hockey players that have come out of Wisconsin. Chris Chelios, you name it. And hockey players, I've got a lot of friends being from the Midwest and went to school at St. Cloud State that are hockey players, and they are very genuine, great people.
Yeah.
My real quick story I'm going to finish with is over the New Year's, I was lucky enough, I've been to a few Rose Bowls when the Badgers have played, and very fortunate. Growing up in Wisconsin was always my dream of going with my dad and my grandpa because we'd watch the Rose Bowl every year. Well, that never happened, but this year I was able to go with my son, who is 7 years old, and wasn't the Badgers playing. My fiance's family is really big Ohio State Buckeye fans, so we went. Unfortunately, my son is starting to become a Buckeyes fan, but I didn't know exactly how he was. It was his first football game. 7-year-olds, they have the attention span of a couple minutes. And it was arguably one of the greatest experiences I've had. I'm a huge football fan. I'll go to the Rose Bowl with regardless of who's playing. And he was leading the OHIO cheers, though he had the whole crowd cheering. We're still talking. What is it, 2 weeks later? Still talking about it. It was a great experience. One of those things that you're always going to, whether you have a daughter or a son, you're going to really remember. So I can't recommend going to the Rose Bowl enough. And as we're talking about this, the fires are raging in that area. But it
It's on
was,
my bucket list. I would love to attend a Rose Bowl,
yeah, do it. Do
100%. And
it.
I'm rooting for the Buckeyes this year as a
Nice.
Boston College graduate. I have no love for the
For
Fighting
Notre Dame.
Irish. So round on the end, high in the middle. Ohio, let's go Buckeyes.
Yes, yes. So it was great. Matt, you should do it. Roll out there, regardless. It is such a scene, so much fun, beautiful weather. Um, Definitely recommend going to the Rose Bowl, but it would be a memory I'll always live with. But Matt, real quickly, where can our audience get more information about Tradr ETFs?
Yeah, so best place is our website. That's just traderetfs.com, TRADR or on LinkedIn. And we have just Trader ETFs on X as well.
Perfect. Matt, thank you so much for coming on the show. I knew it would be a really good episode, and it was. It did not disappoint. I think maybe at the end we should put a poll out there on who wore the quarters at best between the two of us, and then I don't know.
Yeah,
I think
Peyton's got nothing on us, right?
yes, exactly. The Mannings, push them to the side. They're done.
Yeah.
But Matt,
Awesome.
thank you so much. And thank you all so much for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all of our other episodes on the Zephyr YouTube channel. And lastly, please give us a follow on the Zephyr LinkedIn page and like and subscribe the YouTube channel. Thank you very much and have a great rest of your week.